Hello viewers, my name is Ayabonga Stofile from Young High School, Crisani East. Welcome to the Eastern Cape Department of Education broadcast studio. Today's lesson is about the balance of payments, more specifically using the tool neglecting the current account. So I'll be here for your full understanding on this particular topic. So we already know that the balance of payment is under the international trade, whereby we record the systematic economic activities or transactions that take place between the South Africa and the rest of the world. So whenever we interact with the rest of the world, we record those under the balance of payments. So the balance of payment has the following components: the current account, of which we're not going to be doing it, and then the second one is the capital transfer account, and we also have the financial account. So this is how the current account looks like. So we're not going to do the current account, we're just going to move to the second one, which is called the capital transfer account. So this account is made specifically to record all the movement of the fixed assets, the things that people own that are tangible, or funds from the sale of the fixed assets from one country to the next country. If they are moving outside the national borders, then we record under the capital transfer account. Also, the debt forgiveness is included under the capital transfer account. The most important thing is to understand that when someone is emigrating a country, someone is leaving South Africa and an individual may decide to sell his or her assets, then that will be recorded under the capital transfer account. So even if a person is entering the borders of a country through immigration, then the flow of money is going to be recorded under the capital transfer account. So the first account that we have under the capital transfer account is lending to the rest of the world. So which means this is the amount of money that we as the country lend to the rest of the world, the rest of the countries. And also we deduct from that the borrowing from the rest of the world. So this includes all the amount of money that we as South Africans borrow from other countries. So these two components, they give us the capital transfer account. The next account is the financial account. So this account is going to record all the currency that are flowing into and out of the country. So which in most cases, they take the shape of investment over a period of just 1 year. So this account reflects the change, or the net change rather, on the asset ownership of a country. The first sub-account that we have is called the net direct investment. Under the net direct investment, we ensure that if a South African decide to invest in any other country by buying, opening up businesses to the rest of the world, then that amount of money is regarded as an asset and it's recorded under the net direct investment. Also, we subtract the amount of money that we as South Africa receive. If an individual is a non-permanent resident of South Africa, decide to come and invest in the Republic of South Africa, that amount of money should be regarded as a liability to us because we owe it to them at the end of the day. So it means we have to pay it. Then the next account is net portfolio investment. This account is mainly made for the individuals who just want to possess the shares, who just want an ownership of the company without having his or her views influencing the management of the company or the business. So this one is regarded as a long-term approach towards the investment. So when the foreign people buy shares in JSE, it's a liability because we are going to get money that has to be paid at a later stage. However, if South Africans are buying the shares from the rest of the world, then that is regarded as an asset although it's an outflow of funds. Now, the difference between these inflow of funds and outflow of funds, it's called the net portfolio investment. The next sub-account is called the net financial derivatives. So the net financial derivative talks to the contract that is made between two or more parties upon the underlying assets. Whatever assets that they agree on, then it's recorded under the financial derivatives. So the value of this one is determined by the value of the underlying assets. For example, if we talk about the stocks in the market, if the value of stock increases, then that's impacting on the net financial derivatives. We talk about the bonds, we talk about the currencies, the interest rates, anything that is tradable, then it's regarded as a net financial derivative in this case. Also, we talk about the securities that depends upon the underlying assets, whether the prices are increasing or the prices are decreasing. The next account is net other investments. Under this account, it contains all the transactions that are not regarded as the direct investments, are not regarded as the portfolio investment, are not regarded as the financial derivatives or the reserve assets. They are included in other investments. So these may include the loans, the trade credits, the deposit, and all other related items are included in this particular account. The next account is called the reserve assets. Under the reserve assets, this is one of the most important accounts in our financial account because it allows an economy to grow at some point. It allows to balance between the foreign currencies and the currency that we are currently using in the Republic of South Africa. So it includes the currencies, the commodities, or other financial capital that are held by the Reserve Bank to finance trade imbalances. So whenever we face the trade imbalances, then the Reserve Bank, either the Reserve Bank can buy the foreign currencies or the Reserve Bank can sell the foreign currencies to influence the liquidity also within the borders of a country. Then we call that the reserve assets. Then we also have the balance on the financial account. This is the sum of all these components under the financial account. So if we add them, we get the balance on the financial account. But in most cases, people talk about the financial account except the reserve assets. That one is referred to as a memo item in this example. Then it's called the balance on the financial account excluding reserve assets. Then we may have also the errors and omissions that will be made in our financial account. They will be recorded under the unrecorded transactions. This is just a template on how the financial account should look like. Net direct investment, net portfolio investment, net other investments, reserve assets, balance on the financial account. Then we exclude the reserve assets, we have the memo item, and then those accounts that have not been recorded, we record them under unrecorded transaction. And now, we already know that the objective of the government is to keep the balance of payment at equilibrium. But it happens that in some instances, the balance of payment does not equal out. If it does not equal, then it means we are having either a positive difference or a negative difference. Then it means there is a balance of payment disequilibrium. This is where in most question papers you will be required to respond to such questions that takes the shape of high order, middle order questions. So you need to know that the balance of payment disequilibrium needs to be rectified. So if the debit entries, that is the outflow of currency, are greater than the inflow of currencies, then that is a deficit that we're talking about. However, if the inflows exceeds the outflows, that is the surplus that we are talking about. So which means we need to rectify the balance of payment in most cases if it gives us a debit entries that are greater than the total credit entries, that is the deficit. So we correct the balance of payment, for example, the capital transfer account, whatever information that we have, provide a proof that South Africa really is a desirable place to live, to work, and officially reside for tax purposes for individuals. Then it shows that there is an effect of immigrants and emigrants that are moving in and out of the borders of a country. But under the financial account, we need to always understand that this will bring more about a perception of investors on whether the country is worth investing in or not. So they decide to invest in South Africa based on the information that they get from the financial account. If there is a deficit, the investors, it means they are decreasing their investments in the country. So that is why we need to rectify the deficit on the financial account. However, if we're having a surplus, it shows that South Africa is a desirable place really for investment because the investors are increasing their level of investment within the borders of a country. So this is some of the concepts that one needs to take into consideration in trying to rectify the balance of payment deficit. So these are the measures to correct that one. So the first one, the Reserve Bank can decide to use the interest rates. We know that the interest rate will have an effect on the cost of borrowing within the borders of a country. Now, if the Reserve Bank may happen to increase their repo rate, it means the cost of borrowing becomes now expensive. So it means the interest rates in general, they are going to increase. People are not going to borrow more money and then they will have less money at their disposal and buy less goods and services from the rest of the world. So the next part talks about the import controls. In the case of import controls, we are trying to control the amount of goods and services that are bought from the rest of the world, so that within the borders of a country, we can be able to have our own productivity. So the first one talks about increased tariffs. So the country can decide to increase the tariffs to make the tax on the imported goods to be actually higher so that people can buy less goods from the rest of the world, trying to minimize the deficit on our balance of payments. Then the next one talks about improved quotas. So if we talk about the quota, this will talk to a physical restriction on the amount of goods that are allowed to join the borders of a country, South Africa in this case. So it means if we improving quotas, we are limiting the number of goods that enter South Africa so that we correct the element of buying more from the rest of the world. Then we also have subsidies. In the case of subsidies, we ensure that we are reducing the subsidies, especially on the goods that are produced from the rest of the world, so that they are not cheaper. Then the next one talks about the exchange controls. In the case of exchange controls, the South African government may decide to either revaluate the value of a currency, making it expensive from the rest of the world, or devaluate the value of a currency, which is actually key. If we devalue the value of a currency, it means the rand becomes weaker. So any person who wants to purchase an item from the rest of the world, that person will be required to use more of rands. Then that is discouraging the imports. Then we also have the diverting trade, whereby there will be an excessive paperwork that will be required for the goods and services to enter the borders of a country, so that they cause a delay. And also if there is a delay, people will be reluctant to want to purchase more from the rest of the world. So in that manner, you may be able to correct the disequilibrium, that is the deficit on the balance of payment. Now, there is an activity here that I want us to be able to look at. So the first question is, how can the South African Reserve Bank reduce the balance of payment deficit? So this requires the information that I just articulated. So you use that information to try and show that the Reserve Bank may be able to reduce the balance of payment deficit in the economy. Then number two, how important is the reserve assets in protecting the value of the rand? So this one talks specifically about an account called the reserve assets. So we talk about the bonds, we talk about the currencies. So we are going to explain their importance in protecting the value of the rand. Remember, if we protect the value of the rand, we guide it against high inflation. So we are going to explain maybe the actions that may be taken by the Reserve Bank to either revaluate or devaluate the value of the currency. So you need to be able to do these particular activities. So we said, just to recap, this is about the balance of payments. So we talked about the balance of payments. Specifically, we said we are not going to do the current account. We're going to focus on the capital transfer account and to focus on the financial account. So we explained the financial account. We talked about the components of the financial account, and also we explained the capital transfer account. We talked about the components of the capital transfer account. Lastly, we were able to rectify the balance of payment deficit. So if the imports exceeds the exports of a country, we talked about such measures. So thank you. We have come to an end of our lesson. You can leave your questions on the comments below. Don't forget to leave the name of your school so we give shout-outs. Please share, recommend, and subscribe to our YouTube channel. Thank you for watching. See you on our next lesson.